As Sarah mentioned, my name is Dan Latendra, and I manage the CDFI activities at Bank of America. In a few moments, we're going to turn to representatives from individual CDFIs who are going to walk through a series of examples of the kinds of projects that they're financing in their communities and the phenomenal impact that they have on their local communities. Make no mistake about it, they are the star of today's show. But before we turn to them, I thought you might find it interesting to hear an investor in CDFI who's been doing this a while and a deep dive into why we and other investors are so supportive of CDFIs over time. As background, I spent the last 32 years focused exclusively on delivering capital to CDFIs as an investor. I've been amazed and encouraged by the tremendous growth of CDFIs and the CDFI industry. Today, Bank of America has more than $2 billion lent to and invested in more than 250 CDFIs operating across the country. And when I'm asked, so why Bank of America supports CDFIs, I could literally point to hundreds, thousands of examples over the course of my career that really drive home the community impact and the reasons we are providing. But all of that impact really boils down to two underlying core reasons or rationale why Bank of America has continued to invest in CDFIs throughout the decades. First, CDFIs extend the reach of investors like Bank of America to communities and clients we could not otherwise serve. That can be geographic reach. CDFIs operate in many communities where Bank of America does not operate branches or have staff, at least not today. They extend our reach in sectors we'd like to have an impact, whether that is in education through charter school finance, primary healthcare facilities, childcare facilities, an extremely complicated and difficult area to finance. CDFIs have staff that are subject matter experts and have spent their careers, their lives, focused on understanding those niches and overcoming the barriers to finance. Without them, we'd never understand all of the challenges of financing those sectors. They extend our reach. CDFIs also extend our reach to clients that do not yet qualify for financing for Bank of America, some startup, small businesses that would benefit and do benefit from the combination of early stage capital and technical assistance that CDFIs bring together to ensure those small businesses' success, eventually allowing them to grow to the point when they become clients of Bank of America or other mainstream financial institutions. Beyond this extension of reach, we've come to understand, and CDFIs understand, our societies really come to understand, that there are important projects that we all want to see created and financed, but that don't pencil out yet, where the cash flow in a childcare facility or a healthcare facility in a rural community or some affordable housing projects, the cash flow doesn't quite cover what's required to pay back the debt, or the collateral coverage is not quite sufficient so that any private sector investor, any of them, would conclude, I can't finance that project, one that we would all want to see financed or created. What we've come to understand is that CDFIs provide a vehicle through which we could provide some small subsidy. That subsidy could come from the federal government in either the form of grants, guarantees, or other forms of subsidy, or state, local governments, private philanthropy, high net worth individuals, and other sources of philanthropy can provide a small amount of subsidy that would be mixed together with a substantial amount of private sector capital that suddenly now allows the project to be financed. Let's be clear, there is not enough philanthropy in the world to grant fund all the things that you and I would like to see financed in rural communities and underserved communities across the country. We can use a small amount of that dear resources of subsidy and mix it with a multitude many fold over 10 times, 20 times of private sector capital together and now find that the financing works. We found this particularly works in the area of disaster response, where CDFIs have actually become our country's financial first responders. To be clear, humanitarian response for health safety is clearly the first issue and need post-disaster. But soon thereafter, as we look to stabilize damaged small businesses, as we look to finance the rebuilding of our communities, CDFIs are able to bring together a small amount of philanthropy that is needed to unlock large sums of private sector capital and allow our communities to rebuild far faster than they would without CDFIs. All of this impact within what I operate as a business, right? My team at Bank of America operates as a business, not within the foundation, not giving money. I lend money to community development financial institutions, which repay us at very high rates of repayment, right? Our historical losses over the life of our portfolio are less than 1/10 of 1%. To be sure, the Bank of America business that lends to CDFIs is not the most profitable business that Bank of America has. It is not. We don't intend it to be. But throughout the decades, each and every year, our CDFI business has performed at a break-even or better basis, which is what we want to see, demonstrating to both us and to other investors that investing in CDFIs is actually a financially sustainable activity. That's our perspective from an investor. That's the theoretical, that's the numbers, that's the finance perspective. What I'd like now to turn to is examples of our CDFI clients, the individuals and organizations that actually do all the hard work, that do all the heavy lifting, and show you the kind of community impact that really only partnering with CDFIs can deliver. Sarah, I really appreciate the opportunity to express our confidence in and our support of these institutions. Thank you so much.
Thanks so much, Dan. Turning it to Aaron now.
Thanks again, Dan. So as Dan mentioned, we are now going to transition to some case studies from some CDFIs themselves. And as I pull up the slides to accompany those presentations, I want to encourage listeners to submit questions for a brief Q&A that we're going to hold after all speakers have presented. So with that, and as I pull up the slides, I want to welcome our first speaker, Mark Kudlowitz, who's the Federal Policy Director at LISC. Mark, take it away.
Yeah, thanks so much, Aaron, and thanks to to NOL for the opportunity to present on the role of CDFIs with housing supply, which rightfully is getting a lot more attention, both here in DC and I think nationally, as our housing crisis has only unfortunately grown, primarily due to being undersupplied. So I wanted to provide what we think is a great example of the ways that CDFIs, banks, and other entities work together to contribute to affordable housing supply in our country. LISC is a national nonprofit affordable housing organization. We are a certified CDFI, and we primarily focus on affordable rental housing, although we finance a lot of other projects, including some Dan mentioned, including early child care facilities, small businesses, and community facilities. But today, I just want to spend a couple minutes talking about the Barrister. This is a project through one of our 37 local offices, in this case, LISC's Greater Cincinnati office. It was developed by, as you can see, Urban Sites Capital Advisor, Over the Rhine Community Housing, which is a local nonprofit housing partner to our Greater Cincinnati office. Importantly, this is a really cool project. It's an adaptive reuse project, including 44 units of affordable family housing. And we all know that it's often very difficult in the rental market to find properties that have the unit sizes sufficient for families. This is the first affordable units in this downtown area in more than 2 decades. So a real win for Cincinnati. List provided support through over $4 million in financing, and that's a pre-development loan, as you can see, of almost 350,000. That tends to be money that's often hard to get from conventional financial institutions because that's the early stage soft costs and work that needs to be done before you can move forward. And a lot of CDFIs are great about providing pre-development financing. We also provided an acquisition loan of a little over 2.6 million, and then permanent financing a little over $1 million. As I mentioned, this is the renovation of 2 adjoining vacant buildings. So it's an adaptive reuse of a former office space in downtown to new residential units. It also has small ground floor retail, important in a downtown mixed-use setting. 15% of the units are going to be affordable to those at the lowest income, under 30% of area median income, while the rest will be between 50 to 60% of AMI. And it's got 24 2-bedroom units and 8 3-bedroom units to serve families in the area. One to point out as well that it's, and I think you'll hear this from the other presenters today, that CDFIs are really masters of aggregating public and private capital, right? We are trying to assemble different sources of funding, private and public resources, to bring projects over the finish line for the communities that we support. In this case, this project had 9% low-income housing tax credits. That was actually through LIFT's affiliate, the National Equity Fund, which is our syndicator of low-income housing tax credits. And importantly, Fifth Third Bank, right, a bank, as we typically see, was the investor. The project also had federal historic tax credits, state housing tax credits, and home investment partnership funds from the city of Cincinnati. So a real team effort between banks, between the public sector, between CDFIs and others to take what was a vacant building and make it into something that's productive, family housing in the downtown Cincinnati area. Thanks, Aaron.
Thank you, Mark. And so next up, we have Diane Standard, who's a senior policy advisor at Hope.
Great. Thank you so much, and good afternoon. So Hope is a CDFI credit union, loan fund, and policy institute serving Alabama, Arkansas, Georgia, Louisiana, Mississippi, and Tennessee. Since 1994, Hope has provided over $4 billion in investments, benefiting more than 3 million people across the Deep South. So through our credit union, we provide access to core financial services like helping people open their first bank account, or buy a car, or own a home or small business. We have over 40,000 credit union members, and approximately half of them were unbanked or underbanked before they joined Hope. Through our loan fund, we deploy federal financing tools like the low-income housing tax credit and new market tax credit and others that catalyze private capital to build hospitals, educational institutions, and other critical community infrastructure in our region. Hope's investments are transformative for the people and places that we serve. A significant amount of our footprint is rural, and we cover roughly 45% of the nation's persistent poverty counties. Today, I wanted to share just sort of one slice of this work we are doing and providing pathways for homeownership. So next slide. Since 1994, Hope has helped about 4,000 people in the Deep South become homeowners. We hear time and time again that without Hope, the dream of ownership would not have been possible. Take, for example, the words of the Cook family, when Mr. Cook said, "It opened up an opportunity for my wife and I to set roots and provide for our children. When I was starting to lose hope in owning a home, Hope came through and gave it back to me." Hope closed on the Cook family's first home in November of last year. Hope's innovation in this space is our affordable housing product, a mortgage loan we have been making for decades to meet the needs of people in our footprint, where people have lower credit scores, lower incomes, and need smaller loans than typically served by other mortgage lenders. Over 80% of Hope's loans have been to first-time homebuyers, and our decades of experience show that this is a good investment, as our loans perform at or above par with the general mortgage market over time. And we've been able to make these gains despite the fact that our region's rural communities have less access to private and public liquidity tools than rural communities in other parts of the country. This is why the bipartisan congressional proposals, such as the Afford Act, which Connor mentioned and Sarah mentioned, this is so important. And specifically, its proposal to create a secondary mortgage market for loans made by CDFIs will help scale up the affordable homeownership opportunities for rural communities and others in our region. Next slide, please. In 2025, Hope had a record year of mortgage originations with nearly 700 loans, the majority of which went to people of color, women, and first-time home buyers. Our average loan size is about $180,000. Being a certified CDFI is really critical in our ability to do this work, as it unlocks private capital from banks and philanthropic institutions. For example, Wells Fargo, Goldman Sachs, and others have partnered with us to provide affordability assistance, such as down payment assistance, in order to unlock the door to homeownership for more people in our region. Next slide, please. We've also been able to combine our traditional mortgage lending expertise with our community development expertise in several ways. These are just 3 recent examples of how Hope has created housing supply, utilizing federal initiatives which mobilize private capital in support of the same. So here, Hope partnered with the New Orleans area of Habitat for Humanity to provide $6.5 million in new market tax credits, creating 68 affordable new homes, including dedicated senior housing. We also paired private financing spurred by the first round of opportunity zones with low-income housing tax credits to create 48 rental homes in Brookhaven, Mississippi, a small rural town of about 12,000 people. And most recently, through Hope's Y16 initiative, Hope is helping turn long-term renters of low-income housing tax credit units to become homeowners by providing them the mortgages to purchase those very same units, and thus building wealth among low-income households in Mississippi. Next slide. So these have just been a few examples of the type of innovation and economic opportunities that CDFIs like Hope are able to accomplish, and what's possible where there's alignment between our community's needs, private capital, and public policy. We're so thankful for the congressional bipartisan support of CDFIs and to our many bank partners over the years. These partnerships are critical in our ability to do this work. Thank you so much, and please feel free to be in touch.
Diane, thanks so much for that presentation. We are going to move right along, and our next speaker is Adam Henson, who's the Chief Operating and Financial Officer at the Lift Fund. Excuse me. Adam, take it away.
Good afternoon. Thank you, Aaron. Thank you for the opportunity today to speak. My name is Adam Henson. As stated by Aaron, I am the Chief Operating and Chief Financial Officer at Lift Fund. Next slide, Aaron. So Lift Fund is a nonprofit community funder. We do a lot of work in micro lending, as well as being a trusted partner with a lot of our colleagues on the call today, but also with the SBA. We work primarily with entrepreneurs who may not have access to traditional banking, but still have that same drive to be a visionary and be successful. While we support small businesses, the work that we do goes hand in hand with the work that many of you on the call today do in supporting affordable housing and in the micro entrepreneur space. The people behind what you do is the same customers that we help, those entrepreneurs that hold down jobs, those folks that have a dream to own a business. And we also are helping those customers be responsive in the events of disaster. So together with all of us on this call today, we hold a holistic needs for the livelihood of small businesses. Next slide. Our vision at Lift Fund is to be a driving force in transforming communities more into a vibrant hub of opportunity, resilience, and economic independence. We fulfill that mission and that vision by offering financial resources and support that promote economic empowerment. 99% of all U.S. firms are small businesses, and they employ the vast majority of workers in the United States. The ripple effect of helping small businesses and communities goes far and wide. Thank you. Since our start in 1994, Lift Fund's work has generated significant economic impact in the communities that we do serve. And through that work, we have distributed close to $1.5 billion in funding to many communities that we all support. I see many of our partners on the call today, and a lot of these partners have been an integral part in the impact that we all have. So I'd like to take a moment to thank and recognize each of you that made that impact possible. Each and every dollar that we fund turns into a $14 impact. So support from our funding partners has helped us bring close to $20 billion in economic impact to support over 105,000 jobs in the communities throughout our footprint. We are first, a little bit more about Lift Fund is we're first to respond in a crisis. We have supported business interruption dating back to Hurricane Katrina. Last year, we funded small businesses in Los Angeles within days of the wildfire disasters to help them pay their employees, to help them stabilize the communities, and be an anchor in those local communities. We are a voice for entrepreneurs, including veterans and their spouses. We're also a partner to many government agencies and private partners to offer loans with 0% interest rates that brings new opportunities to new places. Banking partnerships are an integral way that we participate with a lot of our programs. So through CRA partnerships with CDFIs like Lift Fund, it allows banks and intermediaries that need to meet regulatory requirements to leverage our expertise and our community reach to responsibly deploy capital and our technical assistance education opportunities. A few examples of that are community development loans, equity investments, or philanthropic support helps provide opportunities for 1 to 5 years that we can leverage within the communities to do a number of things, including supporting microloans, but also supporting disaster relief responses. Next slide, please. As we talk a little bit more about disaster recovery, one of the things that we have noticed is that there has been a lack of timely and responsive response in the event of a disaster. So we've built a national model that helps support small businesses in the event of a crisis. We want to be a model that can allow other institutions to be a standing board or a platform to be extremely responsive in the event of a crisis. When disasters strike, those small businesses are often among the hardest hit in the economy and may lack the necessary reserves or access to quick capital that is needed to keep their employees employed and their businesses open in the economy. Our model focuses on a rapid response, flexible financing, and strong philanthropic support with many of the banking partners that we have on the call today. We are able to quickly and effectively affect those communities. Up to 40% of the businesses that we helped during some of the disasters that we have been responsive to could close permanently if they weren't able to receive funding within a 2-week deadly gap. Across the country, we have helped more than 12,000 business owners rebuild after disasters, deploying $228 million in recovery capital and helping sustain over 47,000 jobs. In the Texas Hill Country floods last year, Lift Fund partnered with many financial institutions and local leaders to deploy $10 million to close to 500 businesses so far. This program is actively being continued. Following the Los Angeles wildfires last year, Lift Fund partnered with private philanthropy and local banking partners that allowed us to deploy close to $2 million in capital to 120 businesses. These funds helped entrepreneurs repair their damage, keep their doors or reopen their doors, and keep their employees working during recovery. It's important for us to communicate as well that we have stood up a National Disaster Response Fund. Our advocacy has generated great interest among decision makers at the state and federal levels where we operate. And I believe that we can find a strong funding partnership for this model to continue as we change the trajectory for communities in recovery. Next slide, please, Aaron. And in closing, I'd like to thank you for the opportunity to share you a little bit more about the work that we do with a lot of the folks on the call today and the work we do at Lift Fund. Please be in touch if there's any questions that we can answer. Thank you, Aaron.
Thank you, Adam. That was great. Before we move to our next speaker, I do want to remind folks that that we have a Q&A function. So if there are questions that come up as you hear these presentations, feel free to submit questions, which we will get to at the end. So with that said, I wanted to welcome our next speaker, Arian Parks, who is the Senior Director for policy advocacy at Enterprise. Arian, take it away.
Thanks, Aaron. I'd like to start by congratulating Sarah, Aaron, and the rest of the NOL team for their leadership in producing this very timely CDFI policy brief and continuing to elevate the role of mission-driven capital and expanding affordable housing. As Aaron mentioned, my name is Ariane Park, and I lead the tax and CDFI policy work at Enterprise. Some of you may also know that before coming to Enterprise, I helped manage the CDFI coalition for nearly a decade as well. Before we dive into some of the case studies, I wanted to briefly introduce Enterprise and the role our CDFI plays in economic development and affordable housing for folks who might not be aware. As the policy brief highlights, I'm sure you know CDFIs help bring capital into communities where traditional financing alone isn't often enough. At Enterprise, we see that every day through the projects that we finance across the country. We have financed over 1 million homes across the country and invested about $90 billion nationally. Next slide. So first, a little bit about Enterprise Community Partners. We're a national nonprofit focused on addressing the affordable housing crisis. For more than 40 years, we have partnered with developers, lenders, investors, and governments at all levels to increase the housing supply and strengthen communities. We work across capital, community development, policy, and on-the-ground technical assistance and capacity building in ways that make homes and communities places of pride, power, and belonging. Next slide. One key way that Enterprise advances this work is through Enterprise Community Loan Fund, which is our CDFI. It's one of the largest nonprofit CDFIs focused on affordable housing in the country. 2025 was a very big year for us. We surpassed a milestone of $3 billion being lent since our launch in 1991. As a part of this work, we provide flexible capital to projects, as I mentioned, that traditional lenders often cannot support alone. And our CDFI plays a really important role in the housing and community development ecosystem by providing patient, mission-driven capital, filling financing gaps, and helping catalyze often complex capital stacks. We frequently partner with banks and other investors to bring capital to underserved markets and support projects that strengthen communities. My federal policy colleagues and I also work to support ECLF, Enterprise Community Loan Fund, by advocating for robust CDFI funding, including Capital Magnet Fund program dollars as well, which serves as a critical source of gap financing for our low-income housing tax credit that the organization does as well. Next slide. So the first one that you will see here is Heritage Manor case study. Rural communities often struggle to preserve affordable housing because the properties operate on thin margins and traditional lenders may be reluctant to step in. I know that the next speaker will go into more depth, I'm sure, on the rural challenges for affordable housing. So I'll keep it to this project in particular. But that is exactly the situation in Mineral Wells, Texas, where the Heritage Manor property is located. Enterprise Community Loan Fund provided an acquisition loan that helps stabilize the property and preserve 36 affordable homes, serving residents earning 30 to 50% of the area median income. The property is part of a broader rural preservation partnership that's between our loan fund and USDA, with Section 515 housing across several communities. The financing enabled repairs and upgrades while keeping rents well below market levels. Investments like this project are critical in rural areas where we're losing even just a small number of affordable homes can have an outsized impact on the local workforce stability and the overall economic activity of those communities. Next slide. Uh, so in high cost regions like the Puget Sound, housing instability and workforce barriers go hand in hand. Hope Workstation North was designed to address both of those challenges at the same time. The development includes 65 units of permanent supportive housing for people experiencing homelessness that's paired with on-site job training and employment pathways. Enterprise helped finance the project using several capital tools, including CDFI lending, low-income housing tax credits, and new markets tax credits. CDFIs often help structure and bridge these complex capital stacks, as mentioned before, providing flexible financing early in the process and helping bring together tax credits, public resources, and private investment to make projects like this feasible. The result here is a model that helps residents stabilize, gain credentials, and reconnect with the workforce while strengthening the broader community. Next slide. In Bennington, Vermont, a historic high school sat vacant for years, leaving a major gap in the community. Enterprise Community Loan Fund provided $7 million in bridge financing to help convert the building into a mixed-use community hub with housing. The redevelopment will include affordable housing, childcare through the YMCA, senior services, and community and commercial space as well. Next slide. So I want to again make clear what these examples show is that CDFIs aren't just lenders, that they are critical partners in the catalytic economic development and housing production in communities. By bringing together the flexible capital, public resources, and private investment, CDFIs are helping move complex projects forward, even in volatile markets. And that is exactly the kind of partnership that we are going to need to scale housing and community investment across the country. Again, I want to thank Nall for increasing awareness on CDFI's role in this work, and I'll turn it back to you, Aaron.
Thank you so much, Ariane. And last, but certainly not least, we are going to turn to Jonathan Harwich, who's the Director of Public Policy at the Housing Assistance Council. Jonathan?
Great. Thanks, Aaron. Thank you to Noel for the brief and for inviting Hack to participate in this webinar, and honored to be on with all of our partners here. As always, I'm blown away by all the work that's being done. Let me just introduce Hack briefly. We are a national intermediary focused solely on affordable rural housing, focused particularly on the most rural and most distressed areas of the country. And like so many of our partners, LISC, Enterprise, Hope, we're a CDFI, but not just a CDFI, in that we have a CDFI, but also couple that with technical assistance and training. We have research and policy on rural areas, and that all informs the work that we do and our work as a CDFI. Here's a snapshot of our portfolio, about $55 million, and our sources of capital. We have 9 bank partners, always looking for more, of course. And also we combine that with awards from the CDFI fund, both the FA award and the Capital Magnet Fund, to do the work that we do. And just a quick look at our year in 2025. Couple things to note. We make loans for both home ownership and rental housing. About a third of ours goes into home ownership. 45 loans in 2025. Our average loan size is about a $500,000. And we'll talk a little bit more about that. But I think as folks have talked about, particularly in rural areas, the scale of the transactions are smaller. and smaller loans are much harder for banks to do directly. And also, we'll note that almost a third of our loans were in persistent poverty counties, which Diane mentioned. Hopes focus on that. Those are places that have had more than 20% of their population poverty for 3 decades. So those are very challenging places to work. And having the flexibility of CDFI capital is really important. Can I get the next slide, Aaron? So in 2025, Hack closed loans in 23 states and Puerto Rico. So we work nationwide. I should mention that Hack is over 50 years old. I think we, as well as another number of other folks on this call, can say that we were CDFIs before CDFIs were a thing. We have made loans all over the country. So if you have an interest, if you're working anywhere, we're able to work with you. If we can go to the next slide. So how do we partner with banks to fill capital gaps? I feel like you guys have heard this punchline a little bit because we share this in common with other CDFIs. Early and small is really important. Pre-development lending, uh, early stage investors to help get projects off the ground. We've done over 5 million in pre-development lending in the last 3 years. These tend to be unsecured, under collateralized, or with alternative collateral that banks can't typically accept. So this is a role that's absolutely critical across housing markets, but it's particularly important in rural areas. And I think as has been shared previously, rural scale permanent financing is desperately needed. Our average permanent loan size is under $500,000, and we do loans as small as 120,000. As Dan kicked us off, so saying like um, banks are in this as a business, but it's not necessarily the most profitable business. The way I would describe it is sort of early and small is not the easiest way to make money off financing. So that's where CDFIs are able to be flexible. We know our borrowers, we know the markets that we work in, and they particularly come to us if they can't find banks who are able to make the loans directly. Can we go to the next slide? So here is an example from Kentucky, and I appreciated Ariane sharing another example of rural housing preservation from the USDA 515 program. I think another thing that is worth noting here is we have partnerships with so many other CDFIs in our work, and in particular around the preservation of this precious 400,000 unit portfolio under the USDA 515 program, which are in danger of exiting due to maturing mortgages and owners having an ability to prepay. We work closely with Enterprise, Lisk, Hope, and others on that. This project closed a $200,000 permanent loan to preserve 24 units of affordable rural housing. As Ariane noted, in rural markets, the loss of any units can be devastating, and HAC has actually just completed some research showing that in rural areas, the lack of increase in net housing supply largely comes from the loss of units, not just 515, but other units as well. So it's pretty critical to preserve these projects. And it's truly the case that but for $200,000, we could have lost 24 units of permanent housing, and it helped leverage low-income housing tax credits as well. And again, this is the kind of permanent loan that would be too small to be of interest to banks or even other conventional affordable housing lenders. So this was a real opportunity for HAC to preserve some precious housing, and it's the kind of work that we've been doing around the country, again, with our bank partners and support from the CDFI Fund. Thank you, and I'll turn it back to Aaron.
Thank you, and thanks again to all of our speakers. At this point, we
members to elevate CDFIs. And I just wanted to close by sharing some key milestones and messages that we're using as part of our advocacy. As Connor mentioned, the Afford Act has been introduced, and roughly 1/3 of the Senate is on board, and we're going to continue encouraging its advancement on future vehicles. The president's budget is also forthcoming, and we expect it to include little to no funding for the CDFI fund. And upon introduction of that budget and the subsequent congressional budget proposals, there'll be a lot of opportunities to highlight the importance of CDFIs and CDFI funding. We'll also continue to advocate for the full release of CDFI fund resources from FA awards to the Capital Magnet Fund. These are all, as you know, critical resources authorized and or appropriated by Congress that are key to housing supply, which is a stated priority of this administration and really timely as, again, the Senate just passed a bipartisan housing package. And, as we did in this webinar, we found it's really important to highlight outcomes and success stories over metrics like the total number of CDFIs. I think demonstrating, as we attempted to in the brief, that CDFIs are critical conduits of capital and create economic opportunity in places that the conventional market cannot profitably reach are important messages to convey. So, and again, it's also critical for members to get to visit CDFIs and see some of these impact stories in real life when they're in district. So that'll help them better understand projects, businesses, and economic opportunities made possible by CDFIs when Congress is on recess. And certainly I can't believe it's already March, but as we head towards the summer and summer recess. So with that, I'd like to thank our partners once again. Thanks to the team for working on this project, and we look forward to continuing to collaborating with everyone here on our collective effort to strengthen and protect CDFIs. Thanks all.